Indian banks often fail due to the accumulation of non-performing assets, also known as bad loans. These bad loans frequently originate from lending to companies already experiencing financial instability. Weak governance, poor management, economic downturns, and regulatory obstacles worsen the crisis. Credit rating agencies, CRAs, evaluate the creditworthiness of banks and companies. CRAs assess loan repayments, cash flow, debts, and overall financial health to determine creditworthiness. Ratings like AAA, very safe, or BBB, moderate risk, influence investor decisions and borrowing rates. Credit rating agencies, CRAs, primarily operate under an issuer pays model. In this model, the entities being rated, such as banks or companies, pay CRAs for their rating services. This payment structure introduces a potential conflict of interest, as CRAs may be incentivized to provide favorable ratings to secure future business.